Willem Vinke is investment advisor to the EI Sturdza Strategic Europe Value Fund, and he joins me now. Willem, it's an EI Sturdza fund, but you're from Lofoten Asset Management. What's the connection?
The Lofoten Asset Management is the investment advisor to the Strategic Europe Value Fund. We do the investment decisions, the analytics, and EI Sturdza does all the operational back-end platform marketing, and that's a combination between the two. So Lofoten does investment and EI Sturdza does everything else.
So what's your background and track record as a fund manager?
I joined the city in 1992 at Morgan Stanley as fixed income sales and trading. Then it became clear after a while that wasn't suited for me longer term, so I joined the equity buy side, Morgan Stanley Asset Management, in '95. I was there for about 7 years until '02. Helped run small cap and large cap European products. Then I joined Jerry Hamble Capital Management. I was there for about 6 years, ran long only European assets as well as a European hedge fund. Then left to go back to the Netherlands, short stint at ING, that didn't work out, and then I thought it was about time that I'd try my own venture and founded Lofoten Asset Management in March '09.
What's the team and the resource level at Lofoten?
Lofoten Asset Management, we're small. In terms of the day-to-day processes, we are three. It's myself, portfolio manager, I have an analyst, and then I have an operations guy to help me on the trading and running the office. However, around that we've got the team of EI Sturdza to rely upon. So we've got an operations team run by Sturdza in Guernsey, and there's about 10 people there, and then we have a marketing team supporting us. So the day-to-day influence in the fund, I would say, is about 10 people. As well as not just the three of us in Lofoten.
And how do you work with that team to help you run the fund?
Well, it's small, so therefore there's lots of communication. We talk all the time. We try and prioritize. Who does what. So it's more like a small partnership. There's no hierarchy or anything like that. It doesn't work in small teams. So try and keep it fun, and it's very focused because we are free from many administrative hassles which you have in larger companies. So today, although I run a small company, I now have more research time than I ever did in any of my previous positions before, which I think is unusual and is not what people think.
Well, how much time can you spend on investing, and how does that compare with previous places you've worked?
I spend about 5% of my time running the company, reporting financial stuff, things like that. I limit my marketing time to about 10% a month, or 10% of my time, so that's 2 days a month, and the rest of the time, therefore it's 85%, is research, meeting companies, meeting analysts, doing my spreadsheets, reading, all of those things. And I would say that larger companies, you would probably have another 20% of your time taken up with committees, group meetings, HR issues, all these kind of things which I don't have. I can just focus on the job.
What do you think the main risks are in running an equity portfolio, and how do you control and monitor those risks?
The most important thing in terms of risk management for portfolio is to get your stocks right. We run a relatively concentrated portfolio, 33 names at 3% is the ideal portfolio construction. Get your stocks right, you'll get your performance. So that's really what we focus on the most. In terms of risk management, I like to keep positions similar. You never know where the performance comes from. Not one stock should be able to blow up a portfolio. So therefore I tend to run positions in equal sizes.
So how important is the benchmark when it comes to, say, sector and country allocation?
Given that the way that we manage the money, we're agnostic to the benchmark. Unfortunately, the risk guys in Guernsey, I start to look at this on a daily basis, and I know what the numbers are. But it doesn't drive the investment process. Our investment process is to find stocks within the criteria that we like, which hopefully will go up, and then how it looks relative to benchmark is a secondary output rather than an input.
So if for whatever reason you didn't like financials, you'd be quite happy to have absolutely nothing in the portfolio?
Correct, absolutely.
Well, given what you look for in a stock, does that give this portfolio some significant sectoral biases?
Absolutely. The types of companies that I'm looking for, you tend to find in certain sectors only. So predominantly in consumer staples, sometimes consumer discretionary, healthcare, software, support services type businesses. We do not really invest in commodity chemicals, oil companies, financials. So there's very strong structural biases to those sectors I mentioned first, and really we ignore the rest most of the time.
So your definition of risk is absolute rather than risk against the benchmark?
We are completely benchmark agnostic. I'm here to try and generate positive returns and do not look at the benchmark at all. I like to buy stocks which I think are going to go up, and if I don't think they're going up, I'm not going to own them. It's quite simple, really.
And how's this fund performed since inception?
We've now been going for about 3.5 years, and we're compounding away at about 15%. The index over that time has done about 10, so it's about a 5% compound return over this period. That said, I think one should perhaps not forget that I started my career in '95, and if you look at my longer term track record, I can show you 10-year numbers there, and they're kind of at a similar outperformance level over a 10-year period.
What's its specific investment objective?
So it's a pan-European fund. It is long only. It is absolute return in its thinking in terms of looking for stocks to go up. It is relatively concentrated, about 35 names. The focus, though, is to find stocks which I think are undervalued based on cash flow analysis, which I tend to do myself or the team does, with a preference for companies which are highly visible revenue streams with hopefully high margins and or high returns of capital, and then focusing on the management focusing on doing the right thing with that free cash flow that they generate. So it tends to have a portfolio tends to have many what I might call somewhat boring stocks, like a Nestle, which is very boring, but actually it's a very good company over the longer term.
And does that mean you've got a low portfolio turnover?
I would hope that the average holding period is 3 years plus in terms of a name. Given the funds now be running about 3.5 years, we're tending towards those numbers. So 3 to 5 year investment horizon on our positions. And invariably you've got some things which come and go a bit quicker than that, but that's where we're heading.
As it's a pan-European fund, how do you manage currency risk?
Many of the companies that we invest in tend to be international operations, and trying to micromanage the currency risk there doesn't make any sense, so I don't. The main thing I do watch at an overall portfolio level is the dollar, the exposure of the dollar and what that might mean, but I tend actually not to hedge the currency very much at all, because I think it's very hard to be making money on hedging currencies.
This fund can invest up to 25% outside Europe. Do you make much use of that power?
The reason that we have that in is from time to time markets can become fully valued, or the types of companies that we're looking for. It's a limited universe in Europe. It's maybe about 300 stocks in reality, because there are many sectors that we don't look at. And therefore I wanted to have the flexibility to go outside Europe if we think that is the right thing to do, or the competitor is more a European company has a US competitor, and maybe you should be buying the US competitor and not the European company, and therefore I wanted to have that flexibility to do that. So at any one time I would say between 2 and 4 positions, so that's between 6 to 10% of the portfolio is invested in companies which are listed outside Europe. But that's nothing new for this fund. I did that previously in my career. And people might say, well, you don't have any experience investing in Japan. I said, well, when I was at Morgan Stanley, I ran EFI products. So I have experience of investing outside of Europe as well.
Do you make active use of cash as an asset class if you think markets are getting a bit toppy?
No, I don't. The remit is long only, and I would hope that my clients expect me to be fully invested at all times, so we do not play around with cash levels. We may or can, from time to time, put options in place, sorry for the pun, as a defensive measure to provide a little bit of downside protection, but it's at the margin in terms of absolute portfolio impact.
What prompts you to sell a stock?
Now that's easy. We do quite an independent and thorough analysis of what we think a company's worth. So I've spent quite a lot of time behind the Excel spreadsheet trying to put a value on the stock. And that's based on cash flow analysis. Operating cash flow minus capex gives you free cash flow, and then you try and value that with the DCF type. Now, that's a framework. It's not perfect, but it's the same framework I've been using for about 15 years, a bit more, 18 years. So I know it works, so hopefully it's not too much garbage in and garbage out. However, this process gives me a view as to what I think a stock is worth. And if a stock hits this level, then the sell process becomes an unemotional one because it's driven by the numbers, and therefore you have to reduce or exit. The mistake many fund managers make is that they hang on to their positions too long. So as I always say, it's easy to fall in love but not to fall out of love.
And do you have an example?
Yeah, last year we sold the position Amadeus. This is a position we'd held since inception, which it's the GDS, it's a Spanish software company, and it's related to travel, volume of travel. It's a very well managed company, but I just couldn't get any more upside on my numbers, and the DCF was fully valued, and we've had to say bye-bye, unfortunately. And then you got to look for the next.
So how often are you monitoring stocks in the portfolio?
You're always monitoring your positions at all time. When you come to a sell decision, you may want to review your numbers, and of course that's what you do. But we try and stay on top of things, quarterly results, analyst presentations, all of these things. So that's a continuous, non-stop process. You spend more time worrying about what you've got rather than the things you haven't got. So.
What's the potential investment universe for this pan-European fund, and how do you narrow that down to 35 stocks?
If you look at the universe above 500 million market cap euros, then I think it's about 1,500, depends a little bit where we're on the market. I run screens. So we can run screens out on sectors or on operating criteria in terms of EBIT or return on capital or just geographical. I may want to go to Sweden for a trip, and then I'll see, well, what else is there in Sweden which may look attractive, and then we might see 4 or 5 companies in the trip and come back, and that generates ideas. So the screen is one sort of idea generating, but often when you look at one company, then actually you may realize that something else might be more interesting. So you'll dismiss the initial company, and then you'll end up buying the second company, which you can't really predict beforehand. Read, research, go to conferences. That's in terms of the idea generation. But the most important thing in my process is the value there, and is that sufficient, and does it fit the criteria in terms of companies which are fairly robust, visible earnings, revenue, high margins, etc.
Do you have any particular market cap bias as a result?
The types of companies that we're looking for sit generally in the mid to large cap space. From time to time there'll be a small cap, but today if I look at the portfolio construction perhaps versus the index, because clients ask these numbers, then we actually have a bit of a large cap bias, and that's been the case since inception.
How does this combination of screens and frontline research gel together? One has to be open-minded at all times, and screens are a starting point. Recently I did actually it was a little while ago now, we were looking at the software sector because the criteria of software in terms of visible revenue potentially might be there or might not be there, and so we ran a screen on software, and the name which came up particular was Sage, which I hadn't seen for a little while and hadn't invested before, so I did the homework on Sage and went to see them and analyst day. And Sage is a company which is accounting software, but it has great visible revenues in terms of recurring revenue. So January 1st, it could, more or less gets 85% of the revenue for the whole year, and has nice margins, 28%. And then there's a change going on from existing products to cloud products, and they seem to be managing that quite well and investing for that. And then they were focusing on giving all their money back in terms of share buybacks and dividends. And therefore the combination of visible revenues, high margins in the high 20s, plus giving it all back to you in share buybacks and dividends is actually a very powerful combination. So that was the ideal stock, if you can call it that way. And it's been a relatively good performer. So. What would you say are the USPs of the Strategic Europe Value Fund?
I would say it's 3 things. Firstly, it's the pool in which we're fishing, preference for higher quality business models. 2, it's the timing. Often we're buying stocks when they're slightly out of favor, contrarian type approach. And thirdly, it's the very strict valuation discipline, which leads to a repeatable process.
Willem Vinke, thank you.
My pleasure. Thank you.